Hi everyone, welcome to the Self Investment channel. In this channel, we'll be talking about the PIR tax rate for New Zealand. I'm focusing on New Zealand for now because there are different countries that has different tax rates, which I will create another video for it also. So stay in touch. However, in this channel, these three things that I will mainly be talking about that they are the prescribed investor rate, PIR, the portfolio investment entity, PIE, and the calculations, just so that you know how you are being taxed based on your portfolio investments. Okay? The prescribed investor rate, PIR, is the tax rate that your portfolio investment entity, PIE, used to work out the tax on your investment income. The PIR is a rate based on your taxable income or earnings earned in the financial year period 1st of April to the 31st of March the following year. So we'll be looking at examples, but we need to understand what the prescribed investor rate is, PIR. So in this case, it's like the individual income tax rates. Our tax rate here in New Zealand will depend on the income earned for the period 1st of April to the 31st of March the following year. And the tax rates are broken down in different categories. There's about 5 categories. The 10.5% is any earnings of $0 to $14,000. 17.5%, that's the tax rate, is any earnings between 14,001 to $48,000. The 30% tax rate is 48,001 to $70,000. The 33% tax rate is 70,001 to $180,000. And the 39% tax rate is any earnings that are over $180,000. You need to understand, and this is the earnings added all together from the 1st of April to the 31st of March the following year. Okay, let's review. 10.5% tax rate, you will be required to pay about $1,470 in tax. 17.5% tax rate, you'll be expected to pay about $5,950 in tax. 30% tax rate, you'll be expected to pay up to $6,600. 33% tax, you'll be expected to pay up to $36,299.67. And the 39% tax rate, you'll be expected to pay just over $70,200. All right, now we have a basic understanding of the tax rate. We will move on to portfolio investment entity. The portfolio investment entity, or PIE, is an entity of investments from investors in different types of passive income investments. An investor will have a number of shares or stocks owned in different companies or business and receive passive income through dividend payments or drawings. And that's just an example of portfolio investment entity. Now let's look at the calculations. We'll look at your wages or drawings or salary earnings. And let's say your salary earnings for the financial year is about 30,000, and your PIE or dividend payments that was made out to you is about $500. Your total earnings for the period 31st March or the financial period it's about $30,500. And in this, there are two tax rates that you need to allocate. There's the tax rate of 10.5% that you'll be required to pay about 1,417 tax. And there's the tax rate of 17.5%. And how do you calculate that? You take a total amount, 30,500 minus 14,000, it equals to 29,100 times 17.5%, and that gives you we pay $5,092.50. Okay, the total tax to pay is $6,562.50. So from the 30,500 total earnings, you will need to pay a tax of $6,562.50. Another example calculation is, let's say your wages earnings amounts to $60,000, your PIE or dividend payment amounts to $20,000, the total earnings is $80,000. There's four tax rates that you need to apply. There's the tax rate of 10.5%. You pay tax of 1,470. There's a tax rate of 17.5% tax that we pay 5,950. And there's tax rate of 30% that we pay 6,600. And there's the tax rate of 33%. And that's about, because it's a small amount in that bracket range, it's about, well, how we calculate it is like $80,000 minus $70,000 equals $10,000 times 33% equals 3,300 that we need to pay in tax. And the total tax to pay is $17,320. So out of the total earnings of $80,000, we pay a tax of $17,320. Thank you for watching. This is all about creating awareness for us, you, me, community, friends, individuals, and to help with our individual self-investment, investing in ourselves with knowledge and money. Take care.